They told us the precious metals markets were stable. They told us the correction was technical, temporary, predictable. They lied. Last Tuesday morning, silver collapsed $6 in a matter of hours. Gold plunged over $200, briefly piercing the $5,000 threshold before a violent snapback. No coordinated announcement, no clear trigger event, just a silent, catastrophic implosion of value, while the financial media manufactured explanations from thin air. When I first saw the intraday charts, I thought my terminal had malfunctioned. Silver whipsawing $12 in a single session, gold swinging three-digit amounts between breakfast and lunch. I watched the tape, and what I saw was not random noise. It was coordinated liquidation pressure, followed by explosive physical buying at levels that defied every supply model I have studied. These are not normal market corrections. These are the signature movements of a system under extraordinary stress, where paper claims and physical reality are violently separating. I have seen this exact pattern before, not in recent volatility spikes, but in the archived trading data from October 1929, in the hyperinflationary spirals of Weimar Germany, and buried in the overnight lending freezes of September 2008. Each time, the initial move looked like a temporary shock. Each time, the experts assured the public that fundamentals remained sound, and each time, what followed was systemic obliteration. We are not watching a dip. We are watching the controlled demolition of confidence in paper pricing mechanisms. But here is the detail that kept me digging through the data until 3 in the morning. The mainstream narrative wants you to believe this was driven by a strengthening dollar and rising inflation expectations. Partially true, but catastrophically incomplete. What they are not telling you is that physical demand during this price collapse reached levels that are mathematically incompatible with a functioning market. Bullion dealers reported their inventories completely wiped out by mid-morning. A single buyer on the East Coast purchased over 400 piece silver dollars in one transaction. Every Morgan dollar in circulation vanished from available stock. This is not profit-taking. This is panic hoarding. When paper prices crater and physical demand explodes simultaneously, you are witnessing the exact moment when the market stops believing in the fiction of synthetic pricing. The crowd is no longer buying certificates promising future delivery. They are clawing for tangible metal they can hold in their hands, because somewhere deep in the collective unconscious, they understand that the system backing those paper promises is fracturing. Let me show you what happened in the autumn of 1929 that nobody teaches in economics courses. In the weeks before the final crash, there was a brief, violent sell-off in equities on Thursday, October 24th. By Monday, October 28th, retail investors, convinced they were witnessing a buying opportunity, poured their savings back into the market. They called it buying the dip. Financial columnists praised their courage and conviction. Within 72 hours, the entire financial architecture of the United States began its terminal collapse. The dip buyers lost everything. Not because they were foolish, but because they misread a systemic rupture as a temporary correction. But here is the detail that haunts me when I look at that data. In the 48 hours before Black Tuesday, physical gold withdrawals from New York banks surged to levels that had never been recorded in peacetime. The wealthy were not buying the dip. They were liquidating paper positions and demanding physical settlement. They understood what was coming. The crowd did not. The Weimar Republic followed an identical trajectory in the summer of 1923. As the mark began its terminal descent, German citizens initially treated currency devaluation as a temporary shock. They bought physical goods, thinking they were getting bargains. Street vendors reported inventory sellouts within hours of opening. By mid-August, shops stopped displaying prices because they could not update them fast enough. By November, A loaf of bread cost billions of marks, and people were burning currency in their fireplaces because it had more heating value than the firewood it could no longer purchase. The rush to tangible assets was not greed. It was the final instinct of a population watching their entire monetary system vaporize in real time. And the wealthy? They had already moved their capital into foreign hard assets months earlier. They were not caught in the collapse. They orchestrated their exit while the public was told to remain calm. What we witnessed last Tuesday was not a correction. It was a test, a probe. The system is checking to see how quickly physical supply can be drained from the market when confidence wavers. And the answer is terrifying: complete depletion in hours. Now let me connect a detail that the financial press buried under geopolitical theater. On the same day that silver and gold prices collapsed, a friendly fire incident occurred in the Middle East. Kuwait mistakenly shot down 3 advanced American fighter jets during a chaotic engagement near Iranian airspace. The media framed this as an isolated tragedy, a regrettable accident in the fog of war. But I want you to consider what this incident actually reveals about the current state of global military coordination and the fragility of the systems we depend on for stability. When allied forces cannot distinguish between friend and enemy in a high-stakes theater of operations, it is not just a tactical failure, it is a symptom of systemic breakdown. These are not poorly trained militia forces making an error in judgment. These are NATO-coordinated, satellite-guided, IFF transponder-equipped military assets that somehow identified Allied aircraft as hostile threats and engaged them with lethal force. That is not a simple mistake. That is a catastrophic failure of command, control, communications, and intelligence systems that are supposed to be infallible. And here is why that matters to financial markets. The same institutions that are supposed to manage military precision are the same institutions backstopping currency stability, managing central bank coordination, and ensuring the integrity of global supply chains. The Pentagon, the Federal Reserve, the Treasury Department, and the major defense contractors are all nodes in the same interconnected web of institutional authority. If they cannot prevent 3 fighter jets from being destroyed by friendly fire in a supposedly controlled military operation, why would you trust them to manage a $700 trillion derivatives market where a single mismarked collateral position can trigger a cascade failure? The answer is, you should not. The Middle East situation is not resolving, it is metastasizing. The initial assumption was that any military response to Iran would be surgical, brief, measured. But the operational reality involves thousands of underground ballistic missiles, the strategic choke point of the Strait of Hormuz, and the potential targeting of an entire regime infrastructure. This is not a one-day operation. This is a prolonged, multi-week campaign with cascading risks to energy supplies, shipping lanes, and currency stability. And while the missiles themselves may be finite, the economic and psychological shockwaves are not. Here is what I noticed in the archived records of the 2008 financial crisis that nobody talks about. In the weeks before Lehman Brothers collapsed, oil prices spiked violently due to Middle Eastern tensions, reaching $147 per barrel in July. Then they crashed to $33 by December, then spiked again. The volatility was not incidental. It was the tremor before the earthquake. But more importantly, it revealed the system's inability to function under multi-vector stress. What actually killed Lehman was not subprime mortgages. It was the overnight lending freeze. On September 15, 2008, the repo market simply stopped functioning. Banks that had relied on rolling over short-term debt every 24 hours suddenly could not access liquidity, not because they were insolvent by traditional measures, but because trust had evaporated. When trust disappears in a fractional reserve system built on leverage, the entire structure implodes within hours. And here is the mechanism that terrifies me. The 2008 crisis was contained because central banks flooded the system with liquidity and governments backstopped the major institutions. But the leverage that caused the crisis was never actually removed. It was papered over. The derivative exposure that stood at $600 trillion in 2008 now exceeds $700 trillion. The margin buffers are thinner, the interconnections are tighter, and this time, central banks are fighting inflation, not deflation. They cannot print their way out without triggering currency collapse. The financial system could not absorb simultaneous shocks to energy prices and credit markets in 2008. When both pressure points were struck at once, the entire edifice froze. We are in that exact configuration again, except the stakes are exponentially higher. We are in that exact configuration again. Soaring oil and natural gas prices, a strengthening dollar that punishes commodity holders, inflation expectations forcing central banks to abandon rate cut plans. And now, a physical precious metals market that is being drained faster than it can be replenished. These are not isolated variables. They are interlocking failure points in a system that has no redundancy left. But here is the mechanism that almost nobody understands. When you see premiums on collectible proof coins collapse to zero, when rare numismatic pieces that normally carry significant markups are suddenly available at spot price, you are not witnessing a buyer's paradise. You are watching the endgame of a liquidity crisis. Let me give you the forensic details that reveal what is actually happening. Proof Eagle silver coins that typically command a 15 to 20% premium over spot price are now selling at parity with uncirculated rounds. Pattern coins from the Eric Newman collection, pieces so rare that only 8 examples exist worldwide, are being quietly offered to dealers at prices that would have been unthinkable 6 months ago. These are not distressed hobbyists liquidating a small collection. These are sophisticated holders with significant capital needs who have exhausted every other liquidity option. Sellers are liquidating everything, even their most prized holdings, because they need cash immediately. Not for profit, for survival. Tax bills, medical emergencies, urgent expenses that cannot wait for markets to recover. And here is the critical insight. When you see forced liquidation at the numismatic level, it means the liquidity crisis has reached the top of the wealth pyramid. The collectors who own museum-quality pieces worth tens of thousands of dollars are not panicking because they read a headline. They are panicking because their accountants and attorneys have told them they need to raise cash now, regardless of losses. This is the identical pattern that appeared in late 1929. Wealthy collectors began quietly liquidating rare art, antiques, and precious heirlooms at steep discounts. Not because they wanted to sell, because they had to. The liquidity crunch had reached the highest levels of wealth. And when I see 3-cent nickel pattern pieces with a population of 22 specimens being offered at spot silver value, I know exactly what that signal means. When the wealthy panic, it means the foundation is cracking. The dealers who are replenishing their silver inventory midday are not benefiting from a healthy market. They are scavenging the wreckage. They are buying from forced sellers who have no choice but to accept brutal losses. This is not commerce. This is wealth transfer during systemic failure. Now let me show you what happens when a physical commodity market breaks under stress. In the final days of the Roman Empire, as the denarius was debased beyond recognition, Roman citizens stopped accepting currency for goods. They demanded payment in grain, livestock, and precious metals. But here is the critical detail that historians often miss. The transition was not gradual. It happened in a matter of weeks. In the spring of 284 AD, merchants in the Roman provinces began refusing payment in denarii for staple goods. They would accept only silver content coins at weight, completely ignoring the face value stamped by imperial authority. By summer, the urban markets had effectively reverted to barter. Currency still existed. It still circulated, but it had lost its primary function as a store of value and medium of exchange. The collective agreement to honor the fiction had simply evaporated. And what did the Roman authorities do? They issued price controls. They mandated acceptance of debased currency under penalty of death. They blamed merchants for hoarding. They executed bakers for raising bread prices. None of it worked. You cannot legislate trust back into existence once it has been destroyed. The market had crossed an invisible threshold where the promises embedded in the currency were recognized as worthless, and no amount of state violence could reverse that recognition. One day currency was accepted. The next week it was refused. The transition was binary, not gradual, and the empire never recovered. Within decades, the Western Roman Empire had collapsed entirely, not from military defeat, but from monetary disintegration that made organized governance impossible. We are approaching that threshold now. The violence of last Tuesday's price action, combined with the immediate depletion of physical inventory, tells us that confidence in paper pricing is fracturing. The market is testing the seams, and the seams are splitting. The mainstream analysts want you to believe that once geopolitical tensions ease and inflation expectations stabilize, precious metals will resume a predictable upward trend. They are projecting silver at $100 by year-end, with some forecasts reaching $150. These are not predictions, they are fantasies. They assume the system remains intact long enough for orderly price discovery to resume. But what if the system does not remain intact? What if the real story is not the price of silver rising to $150, but the moment when physical silver simply becomes unavailable at any paper price? What if we are not heading toward higher valuations, but toward a complete decoupling of physical and paper markets? This is what happened in Weimar. The price of gold in marks became irrelevant because nobody would sell gold for marks at any price. The currency had lost its claim on tangible value. The system had broken. I want you to consider a scenario that no financial advisor will discuss with you, because acknowledging it would destroy their entire business model. Imagine that 3 months from now, you attempt to convert your paper silver holdings into physical metal. You call a dealer. They tell you there is a 6-week delivery delay. You call another dealer. 8 weeks. You call a third. 12 weeks. You check the spot price on your screen. It says $85 per ounce. But nobody is selling physical metal at that price. Not because they are greedy, because they understand that the paper claim you hold is no longer redeemable in the real world. You call your brokerage. They assure you that your silver ETF shares are fully backed by physical metal held in secure vaults. You request delivery. They tell you that physical settlement requires a minimum contract size of 5,000 ounces and involves a complex delivery process that will take several months to complete. You do not have 5,000 ounces. You have 300 shares of an ETF. You are told you can sell your shares and use the cash to purchase physical silver elsewhere. But when you try to do so, you discover that elsewhere no longer exists at the prices your screen is displaying. This is not speculation. This is the mathematical inevitability of a market where physical demand exceeds available supply and confidence in synthetic pricing collapses. The paper price becomes an abstraction, a number on a screen that has no connection to the actual cost of acquiring tangible metal. This is precisely what happened in Weimar. The official exchange rate for gold in marks became irrelevant because nobody would sell gold for marks at any posted price. The currency had lost its claim on tangible value. The system had broken. The quoted price and the actual transaction price diverged so completely that the quote itself became meaningless. And when that divergence occurs in the precious metals market, it will not announce itself with a headline. It will reveal itself through delivery delays that keep extending, through premiums that keep widening, through contracts that settle in cash instead of metal, and through a growing realization that the number on your screen represents a claim that cannot be honored. The elites are already positioning. They are moving capital into hard assets, into land, into resources that cannot be diluted by monetary policy. They are not buying silver at $83 hoping it hits 150. They are buying because they know the denominator is disintegrating. They are not fleeing to safety. They are fleeing from fiction. And while they reposition in silence, the public is being told to remain calm, to trust the stress tests, to believe that the system has safeguards in place to prevent another 2008. But the safeguards are not real. They are accounting tricks. Regulatory theater. The leverage in the derivatives markets is higher now than it was in 2008. The interconnection between global banks is tighter. The margin for error is non-existent. When the next cascade begins, it will not be gradual. It will be instantaneous. One institution will fail, then 3, then 30. The clearinghouses will freeze. The exchanges will halt trading. And the paper promises that currently represent trillions of dollars in supposed value will reveal themselves to be nothing more than entries in a database that no longer functions. I am not telling you this to frighten you into action. I am telling you this because you deserve to understand what the data is actually revealing. The volatility we witnessed last Tuesday was not an anomaly. It was a warning shot. A system under this much stress does not stabilize. It ruptures. And when it ruptures, the question will not be whether you bought silver at $70 or $85. The question will be whether you understood that the architecture holding your wealth was built on promises that were never going to be kept. The silence is deafening. The institutions that are supposed to sound the alarm are instead manufacturing reassurance. The analysts who are supposed to warn of systemic risk are instead projecting price targets. The regulators who are supposed to enforce stability are instead rearranging deck chairs while the hull takes on water. But if you know where to look, the signals are everywhere. $6 intraday collapses in silver, $200 swings in gold, physical inventories depleted in hours, friendly fire incidents in geopolitical powder kegs, forced liquidations of rare assets at spot prices. These are not random events. They are the signature of a system in terminal decline. So I leave you with this question, and I want you to sit with it. What happens when the crowd that is currently buying the dip realizes they are not buying a discount, but catching a falling knife in a burning building? What happens when the panic to acquire physical metal overwhelms the system's ability to deliver? What happens when the paper price and the physical reality finally, irrevocably diverge? Because that moment is not theoretical. It is not distant. It is approaching with mathematical certainty. And when it arrives, the only thing that will matter is whether you understood the difference between a price correction and a systemic collapse. The crash is not coming. It is already here. It is just unfolding in slow motion, one whipsaw at a time, while everyone is watching the wrong indicators.